Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading report for October 29th, 2016. The market is in bullish normal conditions. On an annual basis, using weekly RSI 14, we are in the middle of neutral with a score of 53 out of 100. On a 10-day basis, using the NDX 10, we are at the bottom end of neutral at 23. We are almost oversold. The threshold to being oversold is 20, so we're right on the border of collapse. Looking at the market mosaic, price with respect to the 200-day moving average is white bullish at 3.06%. That means we are 1% away from long-term market condition of sideways, and that's been decaying here lately, and that's a sign of weakness. White bullish means that it's not among the strongest postures of the market in the last 6 months. The slope of the 50-day moving average is a minus 0.2. That is red bearish, meaning that's one of the weakest readings in the slope of the 50 in the last 6 months, and that's a sign of a decaying market. The ADX 14 reads 26.3. That is a strong trending move, and that is a downward trend because the bears are in charge. So that's a negative case where we have accelerating weakness. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is at 0.978, so we are into risk off conditions. We take that score of 0.978, compare it to the last 5,000 trading days, and compute the average and the standard deviation, which gives us the risk z-score, which is at minus 0.33. That means we're 1/3 standard deviation below the long-term market average. Here you can see a 90-day histogram of that indicator. We've dipped into the red after barely peaking up into the green. And this is a market that is ripe for volatility, shock surprises, and sharp moves to the downside, as we saw Thursday and Friday of last week. And as we are approaching a presidential election, the most contentious one in recent memory, and having blockbuster news over the weekend, I expect the volatility spikes to be all over the place as the market reacts to political uncertainty. That means this is a great time to not be initiating new swing trades, to harvesting profits that you have in hand, to being ready for intraday sharp moves, but holding nothing overnight. That's my plan personally through the November 8th election, and then by then we'll know who the new president is, and we'll be able to start assessing the effect on sectors after that time. So a couple more weeks of volatile moves, and day traders will be rewarded. Next up is the blended monthly rebalancing. Here you can see the current holdings in the ETF 13, 22, and 32 portfolios. The rebalancing is due on 1 November. You can see the current leaders in each of those portfolios, and we'll be making those changes in the middle of this upcoming week. In ETF 2, the theoretical exposure is at 70%. The model portfolio will be at 100% exposed. This is a quick look at the blended monthly rebalancing portfolios for ETF 13 and 32. You can see right now that most of them are on cash positions, meaning that prices below their 4-month moving average. The leaders remain Latin America, Japan, emerging markets, and U.S. tech. Everything else is under water in the ETF 13. In ETF 32, the leaders remain Brazil, Latin America, the BRIC countries, commodities, Japan, U.S. tech, China, and so forth. And then the weakest sectors, U.S. real estate, treasuries, and all things U.S. So that's a trend that's been in place now for months. ETF Max is the top 40 or so ETFs in the ETF2 database. What I look for are greens across the board, and then any surprising moves in the 1 week percentage here. So at the top of the blended monthly performance, coal, Russia, energy, the Brazil, all over the place of every type. market vectors, consumers, small caps, everything Brazil is working. Sugar is looking good. We had a nice performance here in coffee. Symbol JO is up was up 5% this past week, and has been a market leader in 1 month, 3 months, and 6 months. So there may be some more momentum plays there. Latin America and emerging, India has had some nice moves this past week as well. S&P 500, this is that ETF2 lens looking at the, and these are the top 40 or so performers in the S&P 500. Akamai Technologies, AKAM, had a 18% week this past week, so we'd be interested in looking for follow-through momentum, along with Baker Hughes. BHI had a great week. Western Digital, KeyCorp, Principal Financials, these all had extraordinary performances this week, and I would be looking for either a continuation of that momentum or a reversal of that momentum as people are looking to lock in profits. So I wouldn't be surprised to see sharp one-day moves in any of those leaders. You could add to that list Juniper Networks, F5 Networks, and Expedia. This is the market health check. The vertical blue lines represent 10, 20, and 30 days of look back. The thick blue is 30 and 60 look backs. The horizontal red lines are support levels that have held in the past, and if the market were to tank here, become price targets on the way down. You can see on the short side, next target around 211, were it priced to leave the floodplain. And then 208, which is a resistance level that dates back almost 70 days. And if that collapses, the next target would be a return to the 200-day moving average, which is indicated in the red shaded area. The slope of the 10-period regression line in blue is slightly up, and you can see the channel formed by the outside blue lines. The slope of the 30 is down, which is negative. And again, you can see the RAF regression channel limits there as well. So downside targets at 211, 208, and 206. Upside targets remain the top of the river at 216, the floodplain at 217, Z3 at 218, which would be an all-time high. And so the channel that we're trading in right now is between 218 and 210. If 210 doesn't hold or 211 doesn't hold, then it's back to the 200 in pretty quick order. This is not a favorable condition for a market right now that has plenty of political uncertainty baked in. I would be unsurprised to see volatility spikes of the magnitude we saw in early September, in which case, where it went from 216 down to 211. That's a 2.5% move in a single day. That is a 3 ATR move in a single day, and that's baked into the cake right now. So we'll be ready on an intraday basis to play volatility and frog moves intraday. I am reluctant to hold anything overnight in either direction in this market till the political uncertainty is resolved. Moving on, ETF2. We have 6 of the 10 broad market sectors are on cash signals, 4 are on buy signals. So the theoretical asset allocation strategy for the globe right now is 40% invested, 60% cash. It's down from 70-30 over last week. So you can see the weakness is spreading around the world. Right now the S&P is rated at 76. EFA is at 76, but tie goes to the globals because they've been stronger. So right now the globals are marginally stronger than the U.S. Inside the U.S., the strength is in technology, then small caps, then mid caps, and then the large caps. The 2 strongest sectors in the market are Latin America and Japan, and the 2 weakest sectors are U.S. mid caps and the S&P, or the European 350s. Inside the U.S. sector spiders, extreme weakness in healthcare, anticipating a Hillary Clinton win, I think, and some strength, such as it is, in U.S. tech, financials, and energy. Otherwise, everything else is below average. This is the world market model. Starting with the U.S., everything in the yellow except for U.S. large cap tech. That's the NASDAQ 100. Otherwise, everything else in the U.S. is below the database average. Everything Europe except for value is below average as well. Inside inside Asia and Asia less Japan, Japan is strong. Rest of Asia is weak. The only symbols for strength in Asia are China and Taiwan. Extreme weakness in Philippines. Latin American emerging markets are excellent right now. Um, Canada is above average, Brazil being by far the strongest area. That's pretty much overheated right now in my view. We're up 40 or 50% from the start of the year, and we have good gains in those areas, and so I'm concerned about profit preservation there more than I am about additional capital improvements. So watch your profit preservation stops carefully on Brazil, because that's like the lone shining star out there in this uncertain world. Oil in the green has been exceptionally strong. Extreme weakness in silver and U.S. real estate. The ETF top 30, this is using that ETF2 lens to look at the broad ETF database. Clear leaders, again, by this methodology, Brazil, technology, Latin America. New members of the top holdings here, Japan and regional banking are green under the strength and white under consistency, meaning they have just recently begun to outperform, and also oil and in the form of USO and OIL are green and red. That's, you almost never see that, so that's an indication of a sharp rise in the price of oil, and so oil is in play and is suited for framing swing and intraday trades as well. White in the strength column and green in the consistency column would be symbols that used to be outstanding and are now starting to decay. So that's going to be Hong Kong, S&P oil and gas, India, Indonesia, pieces of Japan, and some of the emerging markets. So this is a market that even the key leaders are beginning to get weak. Inside the Dow 30, two clear leaders, Apple and Microsoft. JP Morgan, green and white, is now among the new emerging leaders. See the former leaders starting to weaken are Intel, Caterpillar, and Merck. About half of the Dow are underwater here in the yellow or red. Walmart, however, has moved off the bottom and is starting to creep up the stack. But real weakness now in AT&T, Home Depot, Pfizer, Nike. So those are some targets. This is the roll-up of ETF liquidity based on the average daily dollar volume of the last 30 days. Those that are in the green under ATR percentage are the ones that are both extremely liquid and volatile enough for to be well suited for day trading. That's the gold miners and the VIX, energy sector, Brazil, oil and gas exploration. Those that are in the red are the ones that are very liquid but extremely unvolatile and difficult to day trade. Shifting to the daily report now, market remains bullish normal, but again, we're only 1% away from sideways. Lots of signals here in channeling and overreaction. I would not take those signals simply because of the proximity to the presidential elections. I think that's more risk than we want, and I would wait until the next round of signals comes through. Plenty of channeling and overreactions and 5DDs to choose from the extended symbol sets, and then there's lots of quality symbols available on the auto framer that test out better than 2 to 1. You can see that based on the ADX, that strength of trend is increasing to a strong bearish trend. Bears are clearly in charge. In the Dow tactical summary, about half a dozen symbols qualify better than 2 to 1 on the auto framer. You got half a dozen with frog quality numbers better than 3. So Intel is very interesting right now. It's got a 3 to 1 frog quality number. It's got 5 to 1 on the auto framer reward to risk. It's the number 1 on the max pain range compression. It's a 5-day down and a channeling. So that's going to be a high priority for trade framing on the short run. Its RSI2 value is at 4. It was an exceptional loser on the 10-day and 1 month, and yet its one-day performance wasn't as bad as others. So this may be a moment for Intel to resume its upward motion. Travelers, Verizon, Caterpillar are also on the short list for quality. Inside the ETF 30, 5 symbols test out better than 2 to 1 on the auto framer, including real estate, oil. The Russell is at 2.6 to 1. And then we've got a whole slew of channeling and overreactions and plenty of 5DDs to choose from. These are the key price levels and stats for the auto framer for those of you using that system. Lots of quality symbols in there to trade. There's oil, Home Depot, real estate, the Russell, Intel, McDonald's, Caterpillar. So lots to choose from. You can be selective. In the bottom set, the regression line fractal framework. Those that are on the top shelf in the green, these are the symbols that are the most numbers of ATRs below their own regression line 270. We take the regression line 270 to be long-term fair value of buy and holders, and these are the ones that are deep value plays, the most numbers of ATR below the fair value. So among the Dow 30, that's Walmart, Pfizer, AT&T, Verizon, and 3M. In the bottom shelf in the red are the ones that are overheated. These are the ones that are the most numbers of ATRs above their RL270. We've seen Apple in the number 2 position there at 5. That used to be 9 ATRs. It's made a significant pullback here in the last week or so. But these are the ones that are all formerly relative strength leaders and have gotten ahead perhaps of their fair value. So we would look at them as either continued momentum plays or possibility of preserving some profits if you're already in them. But these are the exceptional outperformers, and then that's the case for each of those different trading populations that you see there. The daily squeezes, these are targets that have been compressed on a daily basis. And in other words, the range is less than 0.7 of their average range in the last 30 days. And yet the range stat is such that if you got a range stat move and used yesterday's prices as your range risk, you would have better than 2 to 1 on a one-day pop. So that's what we call the daily squeezes. We have 2 symbols to choose from there, JKK and Walmart. So Walmart is one that would be well suited for that kind of one-day pop. In the market mosaic, you can see that the slope of the 30-period regression line is down, although there has been some improvements here in the polynomial, so there are still some upward pressures. But again, this is typical of a market that is extremely vulnerable to sudden volatility shocks, and everything you see in the 30-period regression line slope statistic and the percent stretch above the 200-day moving average is all filled with warning signs for dangerous waters ahead. So that reinforces the notion of keep your powder dry. Don't start new swing trades until after the election. I'm just going to flip through the fail stats, gain stats, gap stats, and signal to noise ratio. You can stop the tape and look at that for reference as needed. And that's everything that I want to cover for the weekend report. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.